Hello, my name is Alice Kaneya. I'm a CPA and the owner of Gold Accounting Tax. We specialize in real estate accounting and tax. Today, I'm going to be covering 1031 exchange tax implications. I had a previous video that I did that was explaining what is 1031 and how to handle the process and be able to benefit from it. 1031 exchange investors have the potential to build greater wealth because they take advantage of tax-deferred opportunity and leverage their own income to achieve higher returns on their investments. When you reinvest through a 1031 exchange, you defer capital gains taxes and depreciation recapture. Instead of paying taxes and having a reduced equity amount, you as the investor can keep the entire equity and make a new investment. By completing a 1031 exchange, you can defer capital gains, taxes incurred on the sale of the relinquished property, and reinvest the entire sale amount into a replacement property. Deferring the payment of taxes allows you to keep those funds in the balance sheet, have a larger reinvestment amount, yield higher returns, and continue building wealth. Depending on the short-term or long-term nature of your investment in the property and whether or not self-employment taxes will factor in, you'd be taxed as low as 0% on your capital gains or as high as 37% on your capital gains. So for you to better understand what is capital gains, I'm going to explain. Capital gains are the profits earned after subtracting the adjusted basis and the cost of sale from the property's sale price. So it's sale price minus adjusted basis minus cost of sale. You'll come up with capital gains. I'll also explain what is adjusted basis or cost basis. So cost basis, you arrive at it when you do original price, purchase price, plus improvements, minus depreciation, you'll come up with net adjusted basis. Also, it's worth noting that during a sale, there are other closing costs such as fees charged by the real estate agent, lawyers' fees, and other closing costs, which reduce the seller's profits. I'll also explain what is equity. So equity is earned value in any property. To determine equity, you take the gross selling price and subtract the closing cost, then subtract the amount of any remaining debt. So it's selling price minus cost of sale minus debt, you arrive at equity. What is depreciation recapture? So depreciation is an annual income tax deduction that allows investors to recover the cost or other basis of certain properties over the time of the properties in use. Depreciation deduction is recaptured by the IRS when the sale price exceeds the adjusted cost basis of a property. If an investor depreciated a property by 100,000 and reduced the property cost basis from 400,000 to 300,000, then they sell the property for 390,000, the investor will owe the IRS 90,000. So the 90,000 is the depreciation recapture. I believe it's best to use a CPA or to seek a CPA guidance as well as a facilitator when doing a 1031 exchange. So if you have any questions, feel free to reach out. My email is alice@goldaccountingtax.com, and I'll be able to answer your questions and also help you with the process of a 1031 exchange. Thank you.